Today we are talking about one of the most critical tech companies in the entire world, ASML. But we're not just going to talk about their amazing technology, no. We're here to solve a really interesting puzzle that's hidden right inside its stock price. And it all starts with one question.
So, this is the big mystery we're going to unravel today. On one hand, you've got a business that honestly looks pretty much flawless. But on the other hand, you have a stock price that seems to be bracing for some kind of bad news. So, what gives? Let's start by looking at the evidence and see just how perfect this business really is.
All right, first things first, we need to establish just how good this company actually is. And trust me, the numbers don't just speak for themselves here, they absolutely shout.
Just look at this. In their last quarter, ASML's operating profits skyrocketed by over 45% compared to the same time last year. You know, that's not just growth. That is what you call explosive profitability. But how on earth did they do that? Okay, so when you look at the full picture, it's just remarkable. Revenue grew by a super healthy 23%, which is great. But look at the operating profit. It shot up by 45%. That means their operating margin jumped by 5 whole percentage points. To put it simply, this company is getting way more profitable on every single dollar it makes. I mean, it is just firing on all cylinders. And here is the single most important takeaway from all this. Their profits are growing nearly twice as fast as their sales. In the business world, that is the ultimate sign. It tells you this is a company with a massive competitive advantage and some serious pricing power.
And, just to top it all off, the company is financially bulletproof. They've got more cash sitting around than they have in long-term debt. So, we've got a fantastic, ridiculously profitable business with a fortress balance sheet, which honestly just makes our original puzzle even more confusing.
Okay, so here comes the plot twist. Right when everything looks absolutely perfect, it turns out there are two completely different stories being told about ASML's future. And this, right here, is where our mystery really kicks into high gear. So in one corner, you've got the company's own management, and they are being super cautious about 2026, talking about all this global uncertainty. But then, in the other corner, you have the Wall Street analysts, and they're forecasting solid, continued growth. I mean, you literally couldn't have a clearer disagreement about what the future holds. And this isn't just some vague, generic corporate talk. Management said this directly on their last earnings call. What it means is that their own customers, the biggest chip makers in the world, are getting hesitant. That tells you the risk they're worried about. It's very real. So we have this massive conflict, right? Incredible performance today versus some very real uncertainty about tomorrow. So how does all this get reflected in the stock price? Well, this is where we finally find the answer to our puzzle. All right, before we go any further, just a real quick definition. The price-to-earnings ratio, or PE, it's basically like a thermometer for how the market is feeling. A high PE means the market's really optimistic about the future. A low PE suggests they're feeling a bit more pessimistic. So let's take a look at ASML's temperature reading, shall we? Its current PE is sitting at 27. But if you look back historically, investors have been willing to pay almost 35 times its earnings. And this tells us one thing loud and clear. Despite its incredible performance, the market is pricing ASML at a big discount to its own recent past. And this brings us right to the solution. Who is the market siding with here? It's not the optimistic analysts. No, that pessimistic price, that lower PE ratio, it tells us that the market is listening to management's warnings and it's pricing in that short-term uncertainty. But whenever you see a disconnect like this, a truly great company facing some short-term headwinds, it can often spell opportunity for a long-term investor. So let's try to put some numbers on what that might actually look like. Okay, let's just run a quick thought experiment. First, we start with the company's current earnings. Then, just for the sake of argument, let's pretend those optimistic analysts are right about the growth over the next couple of years. If we do that, we get to a future earnings per share of around 29.5 euros. Now, the last step is the really interesting part. What if the market's pessimism just fades away and the stock starts trading at its old historical average PE multiple again? Well, when you run that math, the result is a potential annualized return of around 28% over the next 2 years. Now, that is a very attractive potential return, and it's created entirely by this gap between today's pessimistic price and the company's historical valuation. So, at the end of the day, this is the trade-off in a nutshell. It's about accepting the clear, short-term risks that management themselves are pointing out for the chance at a potentially exceptional, long-term reward if the company can get through this period and its valuation recovers.
And that leaves us with this final question. ASML is a unique, one-of-a-kind, dominant business. So is the market's current pessimism just a temporary storm, or is it a real sign of trouble ahead? Is today's uncertainty a worthwhile price to pay for access to tomorrow's powerful growth? That's really the multi-billion-dollar question that investors have to answer.